So what we have seen repeatedly over the last decade is tax cut after tax cut after tax cut for retirees during that time frame, the mid to late 60s. It could be that you pay zero federal income tax. We refer to it as the golden years. It's the 66th through 69th birthday years.
Another day, another way. Sometimes the song beats the ground. Another day, yeah, another way. Sometimes the rain it falls on down. Another day, another setting for another way.
This is Lambo live from FinCon 2025 in Portland, Oregon. And you guessed it, they always have a podcast booth. And today we have the pleasure of recording here in Portland with Sean Mullaney. Sean Mullaney has got a book coming out called Tax Planning to and Through Early Retirement. Sean is an advice-only financial planner and focuses on the years immediately before and after retirement. Sean's a CPA, and he writes a blog, FITaxGuy.com, focused on the intersection of tax and financial independence. He's a frequent guest on many podcasts. I've heard him many times, and he's been quoted in the Wall Street Journal, the New York Times, and Market Watch. Sean has a co-author, Cody Garett, who's a certified financial planner. They both add a different perspective in this book. Sean, I'm glad you're here today, because I am so worried about the tax torpedoes, IRMA, RMDs, the widow's trap, whatever that is, tax bombs, and hey, I heard stop putting money in 401ks is a good idea. I need to tell all my kids, man. Sean, what is going on with all these headline grabbers in the tax world and in social media?
So, Paul, thanks so much for having me on. I appreciate it. So, yes, there's a lot of worry and concern, and it's around, oh no, taxes are going up. In retirement, I'm a sitting duck. And I think we have to step back and think about two things. One is, how do advisors, influencers, others get time and attention, clicks and views? Well, panic and certainly anxiety and this sort of what I refer to as the inchoate fear, right? Retirement taxes are going up. It's going to be bad. So that's one thing to keep in mind, right? There's incentive, and that sometimes works towards pushing out a message that, oh no, it's a bad thing to have money in a retirement account. The second thing we've sort of lost focus on is this notion that, wait a minute, I go to work every day during my accumulation years. I build up wealth. I have a W-2 job. They pay me because I go to the office every day or I do this productive pursuit every day. What's my taxes going to look like, right? Versus I'm retired. I sleep in, or maybe I get up and I go somewhere, but I'm not going anywhere to earn an income.
Right.
We've come up with this crazy notion that when I'm not trying to earn an income, I'm going to have more income. That doesn't make a lot of sense when we step back and say, wait a minute, if I get a bonus in December, I pay taxes on that.
Right.
Maybe I could defer some of it into a 401k, but for the most part, I'm just going to pay taxes on that. Doesn't matter if I'm spending it today, tomorrow, 10 years from now, 20 years from now, I just pay taxes on that.
Right.
Versus in retirement, I'm only paying taxes, generally speaking, to the extent I'm spending. So in retirement, our spending forms a natural ceiling on our taxable income versus in our working years, our spending is not a natural ceiling. And in fact, many folks in the audience who are thinking about things like financial independence, retiring early, they're going to wind up having income that far exceeds their spending.
Absolutely. Hopefully that gap is large, because that certainly is the fuel that enables early retirement or financial independence. When you have assets that exceed what your expenses are, and generate income to cover those expenses. That's an interesting perspective, because what you want to do while you're still working and generating a paycheck, to be strategic so that whenever you decide you're going to be retired, you have the assets in the right places to optimize how you draw those down from a tax point of view. Is that a fundamental change or shift that people need to make?
Well, Paul, I think you need to think about how retirees are taxed. And thanks so much for talking about our book. I very much appreciate it.
Yeah.
One of the things we do throughout the book is present illustrations of just how retirees are taxed. Because that's sort of gotten lost in the weeds here is, oh no, taxes are going up in retirement. Well, wait a minute. Can we step back and actually look at, all right, you have this Social Security income, this traditional IRA income, whatever it might be in retirement. Can we break down how that's taxed? And one of the things we see is in retirement, especially in today's environment, you have a very high standard deduction. And now for 4 years at least, you're going to have this thing called the senior deduction. And what that means is if you did not defer money into traditional retirement accounts during your working years, you're leaving a wonderful opportunity on the table. You work, you put money into a traditional 401k, you get to deduct that from your income. Doesn't matter what your marginal rate is, it's your marginal rate. So it might, even if it's 10 cents on the dollar, that's still valuable. But for many listeners who are still working, that's going to be 22 cents on the dollar, 24 cents on the dollar, 32 cents on the dollar. Well, okay, get to your mid to late 60s, you're taking that money out of a traditional IRA. That money might be sheltered from income taxation by the very high standard deduction and the senior deduction. So that's a 0% rate on that traditional IRA withdrawal. And then maybe it's taxed at 10% or 12% or 22%. The odds are you're going to make a profit on that difference. You deduct it at 22%, you deduct it at 24%, whatever it is. And then you start including it back into income in retirement against the standard deduction, the 10%, the 12%. Odds are for most Americans and even most affluent Americans, that difference is going to work in your favor, not the IRS's favor.
Right. So if I heard that right, let's say you have deferred that income and maybe you're at a 24% tax bracket. So you basically don't pay that 24% tax, let's say when you're 52 still working. And then you retire a little early and you need to draw money out of that 401k plan. And let's say you have some other assets in a non-taxable account, after-tax money you invested, right? You can blend how much you draw out of that 401k and supplement that with after-tax money to literally stay in the zero tax bracket or the 10% tax bracket, or let's say you're living on $80,000 a year. You mix it to where you're not taxed as much.
In the book, Paul, we talk about some people using blending strategies. We tend to like that. You know, I'll speak for my co-author, Cody, here, but, you know, talk to him individually. But we tend to like that for those looking to optimize for a premium tax credit. So what I mean by that is, say you retire, you're 58 years old. You look at your taxable brokerage account, you say, boy, there's 3 years worth of expenses here. Well, one strategy you could employ is just spend that down over the first 3 years and keep your taxable income super low. For the person looking for a 7-year optimization strategy, we don't like that, though, because we like to keep income, like you're saying, sort of moderate for those 7 years. But let's say you're a little different. Let's say you retire at age 66, so premium tax credit's off the table. I tend to favor fully going taxable account, not blending, like you're saying.
Right.
But what you could do instead is you would fund your living expenses off your taxable brokerage account. You have capital gains income, but we have basis recovery and favored tax rates. So that could be a zero tax situation.
Right.
And then separately, to pump your income a little bit up, do Roth conversions. So you're synthetically, I mean, I guess money's fungible, but you're still taking money from that traditional IRA. You're just not living off it, off of it while the taxable accounts are still there.
And you're utilizing the power of those low brackets.
And the standard deduction, the low brackets. That's exactly right. And for some people during that time frame, the mid to late 60s, it could be that you pay zero federal income tax and do some Roth conversions, and you're still in a pretty good place. So there are a lot of opportunities on the table, particularly in that later period. In the book, we refer to it as the golden years. It's the 66th through 69th birthday years. We call it the golden years for a number of reasons. One, premium tax credit for an ACA medical insurance plan, just not a factor. Two, you don't have to take these so-called required minimum distributions. I think we'll come back to those a little later, but you don't have to take those in your late 60s. And 3, you get to delay claiming Social Security. For the financially affluent, we tend to very much like delaying Social Security. That increases the amount you get every year. Now, yes, it's delayed, but you get this delayed earnings credit situation. So that helps later in life. And it keeps your income lower in your mid to late 60s so that you could do more tax planning.
Right. Personally, there's a lot of content out there on Social Security claiming strategies. When you have spouses, a husband and a wife or whatever, that has 2 different Social Security accounts and one significantly larger, the general consensus is you let that one accumulate, take it at 70 if you can afford to leave that money in. And I guess my question is, maybe taking the other spouses earlier where it's funds part of your budget. Is that kind of dangerous? Does it trigger things that I should be aware of?
So, Paul, the first part you said, it's funny. Cody and I think of ourselves as counter to a lot of the conventional wisdom. But this is one where we go with the conventional wisdom.
Yeah.
For the higher earning spouse, Paul, you, us, and all the conventional wisdom commentators, there's consensus on this. And look, you got to do you. There's no golden answer, but we generally like for that higher earning spouse, delay to age 70 claiming. That has benefits for the married couple as a married couple in retirement, and it has benefits for either spouse as the survivor, because the survivor, no matter who it is, will collect that higher benefit, and it delays income for tax planning. Now you're getting to the lower earning spouse.
Right.
And this is a much more complicated question. And we have a lot less religion on this. Now, there can be tax planning arguments and volatility arguments for that person delaying too. That's not a optimization strategy, but that could be a strategy because, one, you want to spend down portfolio assets and build up even the lower earning spouse's benefit later on in life. And 2, you may not want to turn on that source of ordinary income until later in life to keep the tax planning window open. Now, I will say this, though, and there's actually a really good calculator on this. I believe it's opensocialsecurity.com. Gentleman named Mike Piper. He's a CPA based in St. Louis.
Right.
He has a fantastic break-even calculator around probabilities. Husband and wife could put it in there.
Yeah.
I was born in 1952. My spouse was born in 1956. Here's our primary, our PIAs and all that stuff, their Social Security earnings history or whatever, and they could get a break even. It tends to be, if you're only looking at break even, that lower earning spouse is going to want to claim sooner rather than later, because that benefit goes away at the first death. But I would counter that, though, and say, and look, I don't have religion on this question. No. I think you got to do you. But there is a counter argument to that, is that optimizing for the absolute most in terms of dollars collected is one of many considerations. 2 of the other considerations being tax planning and this idea of less volatility, right? When we spend down the portfolio assets first, we're spending down our more volatile asset first. So maybe that's preferable from an investment perspective. And I'm not giving investment advice to you or anyone else, but
no, we are not today in the show.
It can be preferable to spend down the portfolio assets, stocks, bonds, mutual funds, ETFs, because they have some volatility when compared to Social Security benefits, which have much less volatility, in my opinion.
So, yes, let's be clear on one thing about Social Security that I think almost everyone knows, but let's just state the obvious here. Social Security, as a pension to individuals, has the gift of being grown at the inflation rate. So this is not just a fixed number you get for the rest of your life. Every year it can be indexed, correct?
Well, not only that, that's true, but you get additional benefits for delaying based on a table, and in those last 3 years, it's 8% a year.
Right.
So there's that as well. That's on top of it. Mm-hmm. So, and just the idea of, like I said, volatility. We go to SSA.gov. We know there's some CPI thing they use to index it for inflation versus our stocks, our bonds. They're all subject to all sorts of risks, and we just don't know. And so I think for a lot of folks, it makes sense to de-risk by, like I'm saying, spending down the portfolio assets sooner, delaying the Social Security, and de-risking that way. But like I said, on that second spouse, on the lower earning spouse, it's a much more complicated and nuanced analysis, and it can be a preference thing.
Right.
And it could just be, look, I want to collect the most money, then earlier tends to make a lot more sense.
I like your word volatility. You said many times, okay, because we can't predict what the market's going to do. Long term, we all continue to believe it's going to go up and to the right. But if you remember the early 2000s and you remember, 10 years of nothing happening really in the market, and here you feel where we are today, AI is kind of hyper inflated some of these big players in the market on the tech side. And if you might feel like it's frothy, this is one way to take some of those risk points off the table in your investments, live on some of that money, and let that Social Security, the second Social Security account, continue to grow for a number of years, and then maybe ultimately to 70. But it's part of the concept of what makes sense for you personally. Finance is personal, and a lot of these decisions, and Sean and I are going to talk about others, they're shades of gray. There's not a right and wrong. And sometimes I like to use the phrase, I'd rather be half right and half wrong than, miss out. But you kind of have a blended approach. Maybe you get part of the benefit. Let's talk a little bit about one of the chapters in the book. I think everybody has this on their mind, but it's called Planning for Uncertainty. And as we talk about tax strategies, there's a lot of assumptions people make when they build their strategy, but there's a lot of unknowns. We don't know what future tax rates are going to look like. One of my personal favorite is, my fear is, what's going to happen with the national debt? At what point is the number of trillions going to be high enough where there's a significant modification to the tax code and it can impact retirees? Can you tell us, how do we get comfortable with all this uncertainty, Sean?
So when we look into the future, it's all a likely analysis. It's not a guaranteed analysis. But what we're trying to do is, in 2025, provide the best explanation as to what future tax rates will look like. And we have some data points that can help us reason there. First one is today's tax rates. We just know the tax rates today. We know the tax laws today. We also know the politicians' motivations. So what we have seen repeatedly over the last decade is tax cut after tax cut after tax cut for retirees, not tax hikes. And in the book, we actually have a little table of all those, summarizing all those tax cuts. And in the far right column, we provide the previous year's national debt level. And part of our thesis is, wait a minute, those trillions of dollars of national debt, as bad and deleterious as they are, have not been a break on not tax hikes, but tax cuts on retirees. Do you trust the politicians? Most listeners are going to say no. Do you trust the politicians to act in the politicians' own best interest?
Yes.
Yes, we do. Well, what do we think is in the politicians' best interest? It is to keep retirees happy. And part of the reason we say that is, if we look at the 2024 election, there's a data point in our book around the age composition of the electorate. Our source claimed 58% of voters in the 2024 election were age 50 or older. So that means the significant majority of the electorate is either near retirees or retirees themselves. Why would Congress and the president have any incentive to increase those voters' taxes? And oh, by the way, the electorate's going to continue to get older, it appears to be. Do politicians occasionally change on a dime? Yes. Do politicians change on a dime when it is against their own political interests? Very rarely, if ever. And so, look, we're not writing a book about 200 years in the future. We're saying, what are the Paul Lamberts of the world who are thinking about their taxes in retirement likely to face?
You're calling that in the book relevant future.
Yeah, we're only analyzing. We're only analyzing the relevant future. We're not saying that 200 years from now, income taxes are going to be super low on retirees. That's not an analysis we make. We're trying to divine out, based on facts known today, what are tax rates likely to be during the relevant future for retirees, and the politicians' motivations, their previously demonstrated history. None of this is coming to a place where we're going to have very significant tax hikes on retirees likely in the relevant future.
Right. In recent history, both of the Trump terms, there's been some significant tax code adjustments or even temporary and permanent measures revised. Is that a red or blue thing, or do both parties like tax cuts?
So it's interesting you say that, Paul. One of our theses is the tax rate environment is likely to be very favorable for retirees during the relevant future, regardless of whether it's Democrats or Republicans. And we really don't mean to make a political statement there. We're literally just looking at what have they done. So the Trump administration now twice with Republican Congresses has increased the standard deduction for retirees and for everyone, but especially very helpful to retirees, and has lowered marginal tax brackets, very helpful to retirees. But what about Democrats? Well, in the year 2022, there's the Secure 2.0 Act.
Right.
And that's a very interesting act because that was a Democrat president, Democrat Congress, and that delayed RMDs for those of us born in the year 1960 or later by 3 years, from age 72 to age 75. That was Democrats. That was not Republicans. So our point isn't to say that Democrats are better than Republicans or Republicans are better than Democrats. It's to say that both politicians of both parties appear to be keenly aware that it is in their own best political interest to keep retirees at least somewhat happy. And the long forecasted tax hikes for retirees never seem to manifest, even though the future keeps happening. And retirees tend to keep getting these little tax cuts, some of them big tax cuts. When we look at the landscape 10 years ago versus now, retiree taxation is so much better today, even though the experts have been claiming tax hikes for retirees. It has not manifested, and the exact opposite has manifested.
Right. So there are some things you point out in the book about mitigating some of the future risk and things like that. But two of the concepts I came across, and I'd like you to explain them for our listeners. One, I think I've heard many times is tax loss harvesting, but there's also a term called tax gain harvesting. And can you kind of tell us the difference, and when would one be employed versus the other? What do you do in both, or what?
It's interesting. So this is with taxable brokerage accounts. So this is not with your retirement account.
Right. So my after-tax money that I've invested in a brokerage account that I've already paid income taxes on that money, but now it's sitting in a brokerage account and it's potentially subject to something called capital gains.
Correct. And so tax gain harvesting, tax loss harvesting, they're actually quite different from each other. And one tends to apply more during the accumulation years, although it can apply during retirement. And then the other one tends to apply much more during retirement, but it could apply during the accumulation years. So tax loss harvesting, that's literally just, I own a stock, bond, ETF, or mutual fund in a brokerage account, and it has what they call a built-in loss. Its current value is less than what I paid for it. Okay. Right. So what I could do is I could trip a capital loss by selling that. And then I have the question of, do I redeploy eventually back to that old stock mutual fund, or do I diversify or go into some other holding?
Right.
Bit of a different question, but the idea is to trip the loss so that you could put it on this year's tax return. And especially for accumulators, this could be valuable because you can deduct up to $3,000 of that loss against other ordinary income. So your W-2.
Right, every year.
Yeah. So this can be valuable, especially for for the working person where they're at their high W-2 level. This could be very, at least somewhat helpful. You say, well, what about retirees and tax loss harvesting? Well, it's a thing, but there may be many retirees who got to retirement because they had gains in their portfolio.
Right.
So it's just not a concept that's really all that germane.
Right. I mean, the early Google employee or Microsoft employee or
they don't have
Apple
any losses.
Employee,
Yeah.
they're sitting on a bunch of stock that they have a basis of almost, well, I won't say nothing, but, let's say you've got $80 Apple stock, and Apple's not $80 anymore. It's significantly higher. So you have a very large capital gain there.
So that's where tax gain harvesting comes in. And what you're doing there is you're taking advantage of, they call it the 0% long-term capital gains tax bracket, which right now for married folks in the year 2025, if I'm remembering my numbers correctly, for a married person, the top of that bracket is $96,700 of income for a single person. It would be half that, $48,350.
Right.
So you could have taxable income. That includes the standard or itemized deductions, as long as your total taxable income, including that triggered gain,
right,
is that number or less, you pay a 0% capital gains rate. So what you could do with that Apple stock is one of two things. Assuming your income is low enough, you could sell and immediately reacquire. That's a basis reset.
Isn't there like some 30-day period, or is that only on buying?
All right.
Okay.
It's interesting you bring up the 30-day period. The 30-day period applies only to tax loss harvesting.
Ah, that's the difference.
It does not apply to tax gain harvesting.
So if I want to leverage that zero capital gain opportunity, I can sell it and turn around and buy it the same day.
Paul, the only thing I would say there is I wouldn't sell it to your brother and then buy it back, right?
Okay.
But as long as you're doing it on a brokerage platform that's matching you with third parties, there's just no rule that polices that tax gain harvesting piece. Part of the reason there's probably no rule on that is that the 0% long-term capital gains bracket is a relatively new phenomenon. And this actually goes back to your previous question. So that phenomenon was enacted was passed in the year 2003, Republican Congress, Republican president. But it was delayed to the year 2008.
Oh.
Well, you may remember there was an election in the year 2008. Yeah. And one party did really well and one party did really badly. So
there was a housing and financial crisis.
That's
true,
too.
Yeah.
So, but what happened was, what's interesting about that election is that was the Obama 2008 election. He won pretty big. Yeah. He had big majorities of Democrats in both houses of Congress going into 2009. Well, okay, the Republicans passed the 0% long-term capital gains rate. Surely the Democrats are going to repeal that, right? Oh, no, they did not. And I think there's something there. In the book, we make this point. It matters what politicians do. It also matters what they don't do.
Yes.
And Democrats had big majorities. And if they wanted to get rid of the 0% long-term capital gains rate, they had majorities and a popular president in the year 2009. They could have done that, and they chose not to.
Yeah.
So maybe this tax policy isn't so destined to be so negative for retirees after all.
I can't resist my favorite Rush lyric here. If you choose not to decide, you still have made a choice. Yeah, absolutely. Not taking action is a decision they consciously make. Well, I think there are a lot of things here that we could get into deeper here, and we're going to be running out of time here pretty quick. So I want to kind of check off a few more things here as we wrap up. There are a lot of topics. Cody, I'm sorry you're not here at FinCon because I actually met you for the first time at FinCon 21 in Austin, and I really enjoyed sitting around a round table with you. Sean, I think it's fair to say you and Cody have a pretty consistent view of philosophy, but you differ in some areas, and the book lets you highlight those differences.
That's right. So Cody and I are very aligned when it comes to big picture tax planning to and through early retirement. Big picture, I can't think of another financial planner that I'm more aligned with than Cody Garett. Okay, so that's great. But there's lots of little details. And so what we do throughout the book is we have occasional Cody's takes and Sean's takes. And they're there because one, two brains are better than one. And two, there are areas that are either just a particular area of emphasis and focus for one of us. So that particular co-author wanted to emphasize that. Or once in a blue moon, there's a respectful disagreement between Cody and me. And so we just have that take as well. So you get two for the price of one. Be a little salesy here, right? So you get two for the price of one when you get a book authored by two authors instead of one. It was a fun project. And Paul, I very much thank you for giving me the time to talk about it today.
Well, I thank you, and I don't want to, and I'm quickly flipping through this book to try to find what the last page was. It's 330-ish pages, but my point is there is a lot of content in here, and the chapters are organized in a way that they stand alone as a topic in most cases. There are certainly examples throughout the book that tie together, but I think this is going to really kind of be more of a reference book on top of a current what makes sense from a tax strategy point of view book in today's environment. Is that a fair appraisal of
Absolutely.
You were trying to do?
We want this book to be something that folks keep as a reference. So we have planning lessons in there and a planning approach that we generally like for most Americans, but we have plenty of tax rules. Planning is the primary focus, But you can't do a tax planning book without some rules. So we have some chapters that are more rules-based, and the idea behind those chapters for many readers is literally going to be, hey, I now have a reference I can come back to look up some of these tax rules. But I would say our primary purpose in writing the book was to focus on the planning aspects.
Right. Well, there's a lot of information in this book. You can find this book on Amazon. It will be available beginning on...
So it's on pre-sale now. We're recording this September 11th. It's up there already for pre-sale, which means you could purchase it now, and then it ships September 23rd. Starting September 23rd, that's when it's officially launched, and everybody can go to Amazon and some other resale, booksellers, and you can just get it there, and then it's just the shipping.
Sean, as a fellow CPA, I appreciate CPAs that spend the time to put words in a book that everybody can understand. I was not a tax guy, no tax expert, and I really enjoy the way you and Cody structure these topics and present them in such a way with a lot of examples and a lot of scenarios that help people understand that aren't tax experts. This is not rocket science, is it, Sean? I mean, why do people get afraid of the tax issues?
So it's sort of like driving to the grocery store. Could you explain all the functionality of your car's engine and all the computers and electronics in your car today? No. But can you drive to the grocery store and get some grass-fed beef and drive home? Yes. And that's sort of where the tax rules are. Nobody needs to memorize thousands of pages of regulations to be able to do their own tax planning. And so that's sort of where we're at on this. You're never going to know every last tax rule. I certainly don't. But you can master the planning concepts to become your own best planner.
That's great. I love it. Let's wrap it up there. Sean, tax planning and strategy is something that matters to everyone. They just need to find a way to implement it and take action on it. And I think the first step is just pure education and learning more and realizing this stuff can't eat you. Okay, this stuff is straightforward if you give it a chance and put the effort in to learn it. Cody, wish the best to you and Sean as this book launches. And I personally am going to go out there and put my pre-order in because I got an advance read and I'm really excited. This is very relevant whether you're still working, looking toward retirement, or in my case, you've retired and you're almost to what he called the golden years, which I think are really interesting in the book, where there's other different opportunities for you from a strategy point of view. So with that, this is a Filighter signing off from Oregon with Sean Mullaney, the Fi tax guy. The Filighter, we're out. Sean, anything, last words?
Just gratitude. Many thanks, Paul, for having me on. It was a pleasure chatting with you.
This episode was recorded in Portland, Oregon, September 11th, 2025. Edited in the Filighter Podcast Studio, September 17th, 2025, College Station, Texas.